welcome to this explainer on Saratoga Investment Corp's Q1 2027 earnings. Today, we've got a fascinating financial tug-of-war to unpack. We're going to be balancing Saratoga's truly remarkable asset growth against the very real sector-wide macroeconomic friction that's putting so much pressure on the broader private credit market right now. If you want to understand how a massive portfolio actually navigates a complex economy, you are in the exact right place. Let's kick things off with a massive number right out of the gate, 14%. I mean, in a volatile market where traditional yields are practically shrinking before our eyes and everyone is starved for current income, Saratoga is somehow posting an annualized 14% dividend yield. And they're doing this while simultaneously growing their assets well past the billion-dollar mark. So how exactly are they pulling that off while others struggle? Well, to figure that out, here is our roadmap. We're going to hit the headline numbers, break down a recent NAV drop, check in on their portfolio credit quality, look at liquidity and dividends, and finally wrap things up with the macro outlook. All right, Section 1, the headline numbers. Let's look at the big picture for Q1 2027. Grounding our analysis right in the official earnings release, we can see that assets under management, or AUM, ticked up 1.6% sequentially. That pushes their total portfolio to a record $1.126 billion. That is a massive milestone, reflecting some serious ongoing momentum. And just as a quick refresher, assets under management is simply the total market value of all the investments the firm is managing. What's cool here is that this AUM growth wasn't just some passive market drift. It was actively fueled by about $31 million in net originations. Basically, they deployed over $79 million into new investments and follow-ons, which easily outpaced their $48.4 million in repayments. They're out there successfully putting capital to work, even with deal dynamics being so incredibly competitive right now. So what is the payoff for all that deployment? Well, despite the persistent headwinds across the private credit space, Saratoga posted a 4.0% return on equity for the last 12 months. To put that in perspective, the broader Business Development Company, or BDC, industry average is sitting at just 2.4%. They are absolutely outperforming their peers on a fundamental level. But hey, top-line growth is only half the story, right? Moving to Section 2, the NAV drop explained. We really need to examine the friction weighing on their overall valuation. For context, net asset value, or NAV, is the total value of the company's assets minus its liabilities, usually on a per-share basis. It's essentially the true underlying worth of what they hold. And during this quarter, Saratoga's NAV actually took a sequential hit, dropping from $24.42 down to $23.23 per share. Which naturally begs the question, if they're growing their asset base and beating the industry average on ROE, what on earth caused a $1.19 per share reduction in NAV? Let's look at the math. The drop really breaks down into two main buckets. First up, a 0.28 hit from under-earning their dividend. Basically, they paid out a little more to shareholders than they brought in from net investment income. But the much bigger piece is a 0.93 hit from unrealized depreciation. A big chunk of this was a specific write-down. A portfolio company called Pepper Palace was marked down all the way to zero, which alone was a $3.9 million impact. On top of that, there was a $6 million broad market adjustment to comparable multiples across their equity positions. So it's really a mix of one specific company struggling, combined with broader market valuations tightening up. All right, keeping those specific markdowns in mind, let's move to Section 3, Portfolio Credit Quality. Let's assess the safety of the rest of that billion-dollar pie. When we break down their asset allocation, you can clearly see their highly defensive posture. A massive 81.7% of their investments are locked into first lien term loans. That means if a portfolio company goes bankrupt, Saratoga is literally at the very front of the line to get paid back. It's a highly structured, very conservative foundation. And this is the crucial takeaway here. Despite the specific write-down of Pepper Palace we just talked about, overall credit quality is still remarkably solid. We're talking 98.3% of their credits rated in their highest internal category. Furthermore, non-accruals, the loans that have actually stopped paying interest, are effectively at 0% of the portfolio's fair value and just 1.2% at cost. The core of this portfolio is incredibly healthy. So how does all this build into shareholder returns? Let's get into Section 4, liquidity and dividends. Well, the company is sitting on a remarkably robust liquidity position. They ended the quarter with $60.8 million in cash and cash equivalents. Plus, they proactively issued $25 million in new 7.25% fixed-rate notes due in 2029. When you add up their cash and their available credit facilities,
They're looking at nearly $197 million in total undrawn borrowing capacity. That is some serious dry powder ready to be deployed accretively into new investments. And having that kind of deep liquidity is exactly what allows them to comfortably support their dividend. They're paying out a highly reliable base dividend of 25 cents per share every single month. If you're an investor laser-focused on current income, a monthly cadence like that is incredibly attractive. Zooming out, that aggregates to 75 cents for the entire quarter. And that steady 75 cents quarterly payout is exactly what's generating that incredible 14% yield we mentioned at the very start of this explainer. It's just a continuous, rock-solid track record of returning capital. Finally, let's look at what's coming down the pike. Section 5, the macro outlook.
Management is being incredibly clear-eyed about the macroeconomic reality right now. They're openly acknowledging that the environment is complex. We've got geopolitical tensions, elevated inflation, and this wild uncertainty around interest rates. All of this is driving a measurable rise in default rates across the broader sector. The cautious sentiment in the market is very real, and we are seeing industry NAVs decline because of it.
But even with those fierce headwinds blowing, CEO Christian L. Oberbeck is standing firm. He notes that their credit-related NAV decline reflects very specific, isolated situations, not some broader portfolio trend. His belief is that their disciplined, first-lien-focused underwriting and super conservative balance sheet position Saratoga perfectly to navigate this stormy environment. Which leaves us with a really compelling question to ponder as we wrap up this explainer. In an era of elevated default risk and skittish market sentiment, will these deeply structured first-line portfolios, like Saratoga's, ultimately serve as the strongest shield for yield-seeking investors? It is absolutely a vital question to keep in mind as we watch the private credit markets evolve this year. Thanks for joining me as we unpack these filings, and I'll catch you next time.